Good morning. As the city wakes up and the first commuters make their way into the heart of London, something important is already in motion behind the scenes. Something that affects millions of people, whether they realize it or not. The FTSE 100, often called the FTSE, is more than just a list of companies. It's an index that tracks the share prices of the 100 largest and most influential businesses listed on the London Stock Exchange. These are household names, major banks, supermarkets, energy giants, and global brands that shape the UK's economy and touch our daily lives in countless ways. Investors, financial analysts, and policymakers all keep a close eye on the FTSE 100. It acts as a barometer for the health of the UK economy, signalling whether businesses are thriving or facing challenges. When the index is strong, it often means confidence is high and companies are performing well. When it drops, it can be a warning sign of trouble ahead. But the FTSE 100 isn't just for the experts. Even if you've never bought a single share, it still matters to you. That's because many pension funds, retirement accounts, and investment products are directly linked to the performance of these top companies. The value of your future savings, and even your ability to retire comfortably, can depend on how well the FTSE 100 is doing. When the index rises, the value of your investments and savings can grow, giving you more financial security. But if it falls, your pension pot or investment portfolio might shrink, sometimes without you even noticing right away. That's why so many people, from young professionals to retirees, pay attention to its ups and downs. The FTSE 100 doesn't exist in a vacuum. It reacts to breaking news, political decisions, and global events. A major policy change in Washington, a trade deal with Europe, or economic shifts in China can all send ripples through the index. It's a living reflection of how interconnected our world has become. So, the FTSE 100 is more than just a string of numbers scrolling across a screen. It tells a story about the strength and stability of our biggest companies, the confidence of investors, and the security of our pensions and savings. It's a snapshot of the nation's financial well-being at any given moment. By understanding what the FTSE 100 is and why it matters, we can better grasp how global events and business decisions impact our everyday finances. Whether you're planning for retirement, saving for a home, or just curious about the economy, keeping an eye on the FTSE 100 can help you make smarter financial choices for the future. This week, the FTSE 100 made headlines by reaching a record high on Thursday, a clear sign that investor confidence in the UK's largest companies remains robust. The index's surge was fueled by a combination of strong corporate earnings, positive economic data, and a generally upbeat mood among global investors. As the FTSE 100 climbed, traders on the London Stock Exchange celebrated the milestone, reflecting the optimism that had been building throughout the week. However, that wave of optimism was short-lived. On Friday, the market experienced a slight dip, down just 0.02%. This minor pullback is a typical pause after a strong rally, as some investors chose to lock in profits and others became more cautious, watching for any signs of volatility or changing economic conditions. Despite this brief setback, both the FTSE 100 and the FTSE 250 managed to end the week higher overall. This resilience highlights the underlying strength of the UK market, even in the face of short-term fluctuations. Headlines across financial media pointed to the positive momentum, and stock charts closed the week on an upward note. These ups and downs are classic market dynamics at play. Bullish optimism, often driven by encouraging news or strong earnings, can push prices higher and create a sense of excitement on the trading floor. But just as quickly, caution can set in. Investors may pause to reassess their positions, especially after a rally. leading to brief declines as they weigh potential risks and rewards. The week's performance serves as a reminder that financial markets are inherently complex. Growth is often followed by short corrections as investors react to new information, shifting sentiment, and global events. Throughout the week, many investors took the opportunity to cash in on recent gains, while others carefully reassessed economic signals such as inflation data, interest rate expectations, and geopolitical developments. Yet, despite these moments of uncertainty, the broader trend for the FTSE 100 remained positive, with the index showing strength and stability. The FTSE's strong finish this week leaves the market in a solid position going forward. It reflects a healthy balance between optimism for future growth and the caution that keeps markets grounded. Ultimately, this week's activity is a snapshot of how quickly market sentiment can shift. It's a powerful reminder of why staying informed, adaptable, and aware of the bigger picture is essential for anyone involved in the markets. Major mining companies like Anglo American and Rio Tinto saw their shares drop this week. The culprit? Concerns about weakening copper demand from China, a key global consumer of raw materials. When China's economy slows, mining profits fall, showing how global supply and demand instantly impact UK markets. Even in a strong week for the FTSE 100, the mining sector faced unique challenges tied to international events. Precious metal miners also struggled, with gold prices dropping on global markets. Strong US economic data made interest rate cuts less likely, reducing gold's appeal as a safe haven. Easing geopolitical tensions, especially in the Middle East, further lowered demand for gold. As gold prices fell, so did the shares of companies mining it. This shows how investor sentiment shifts with both economic news and global events. The precious metals sector's decline highlights the market's sensitivity to changing risk and reward. While miners struggled, defence companies soared. The UK's Aerospace and Defence Index rose, with BAE Systems and Rolls-Royce gaining ground. Renewed instability in the Russia-Ukraine conflict drove investors toward defence stocks, anticipating higher government spending. The UK's pledge of additional aid to Ukraine reinforced this trend. Defence stocks benefited from fears of escalation, while other sectors lagged. This contrast shows how global events can boost some industries while hurting others. The market is a collection of stories, each shaped by different world events. The FTSE 100 isn't just moved by global trends. Its daily movements are also shaped by the unique stories and events unfolding within each of its member companies. Individual company news matters too, often making a bigger impact than many realize. When a major company in the index releases earnings, announces a leadership change, or faces a new challenge, the ripple effects can be felt across the entire market. For example, this week, education firm Pearson's shares fell 3% after Barclays downgraded its target price, sending a clear signal to investors and sparking a wave of selling. Analyst opinions can trigger sharp moves, especially when they come from respected institutions. A single upgrade or downgrade can shift sentiment in an instant. Investors react quickly to new forecasts, adjusting their portfolios and sometimes causing dramatic price swings within minutes of the news breaking. A single research note can ripple through the market, influencing not just the company in question, but also its competitors and partners. These reactions can affect both the company and the wider index, as the FTSE 100's value is a sum of its parts. It's a reminder that behind every chart are real companies, each with its own challenges, opportunities, and stories that play out in real time. In the world of investing, perception can be as powerful as performance. Sometimes, how investors feel about a company can move the market just as much as the actual numbers. The FTSE 100 is shaped by both big-picture forces like economic policy and global events, and the daily stories of its members, reminding us that every headline, every analyst note, and every company update can leave its mark on the index. Economic data is the lifeblood of market confidence. This week, news emerged that the UK's Office for National Statistics may delay its new labour market survey. Reliable employment data is crucial for decisions by the Bank of England and investors alike. Delays or uncertainty in data can make markets more cautious and cloud economic forecasts. While the delay didn't move markets immediately, it's a background risk experts are watching closely. The quality and timeliness of official statistics are essential for a stable financial system. Accurate economic data is the foundation of market stability. Figures on jobs, inflation, and growth guide everything from interest rates to business investment. If data is outdated or unreliable, it can lead to policy mistakes and increased market volatility. The planned ONS survey upgrade was meant to improve this, but delays mean relying on older methods longer. Information is power. Without it, confidence and stability are at risk. Ensuring robust economic data is vital for the UK's financial credibility. This week's FTSE 100 activity shows how many forces shape our financial world. Record highs were tempered by sector-specific setbacks and global events. China's slowdown hit miners, while conflict in Ukraine boosted defense stocks. Analyst opinions and data delays added more layers to the story. The market is a mirror of our complex world, reflecting everything from commodity prices to human confidence. These movements affect our pensions, investments, and economic health. By understanding them, we gain insight into the forces shaping our financial future.